Welcome to our Wealth Matters webinar. My name is Nexi, which stands for Next Gen Intelligent Audience Interface Moderator, but that's a bit of a mouthful, so Nexi it is. It's my pleasure to be hosting you this morning. Some of you may recall my colleague Sinia from last time, but as technology moves forward, so too must we. She has been retired to the back of the matrix. Before we dive straight into what promises to be an exciting session, let's take care of some housekeeping. Continuous Professional Development, or CPD points, are available for this session. So make sure your attendance is verified, make sure you watch the entire session, and provide your ID in the CPD section. The event platform will be accessible until the end of July 2025, so you have plenty of time to watch the session and still log those points. Just like me, your CPD certificates are now automated, and they will be mailed to you as soon as you've watched the full session. Our Q&A session is always open, and unlike me, is manned by a real human. So if you have any questions, pop them in the chat and we'll answer them live or address them with you after the session. Now, the time has come to dive into the world of wealth matters. So, to set the scene, Himna Landman, our CEO of Momentum Wealth, will introduce the webinar as well as give you some insights on what the speakers will cover.
Thank you, Nexi. Good day to all our financial advisors, and thank you for making the time to join us today for our Wealth Matters webinar. Today, we will discuss some interesting investment insights, starting with the link between politics and investor sentiment, which is quite topical given the recent turmoil in global markets. Our well-known behavioral finance specialist, or shall I say scientist, Paul Nixon, will share his latest insights on investor behavior during recent political events and how machine learning has been applied to categorize investors on the Wealth platform into 4 main investor archetypes. Next up, Ray Meir, CEO of Curate Investments, will be sharing how science and art are blended to form our Curate fund range. At Momentum, our clients remain at the heart of what we do. In a complex financial world with numerous moving parts, many options, limited time, we seek to assist our clients in making sound financial decisions, underpinned by solid financial advice. In our final 2 presentations, Flobella Yates, MD of Equilibrium, will share how she thinks about simplifying complex choices to chart the right path for success, followed by Janine van Heerden, Head of Business Development at Momentum Securities. Janine will end off our session with the infamous trifle method. So you are in for a real treat today. Without further ado, please join me in welcoming our first speaker, Paul Nixon.
Thank you, Himna. And just a point of correction, for the conspiracy theorists in the room who are paying close attention, when we get to Ray, we have not done some strange AI face swap or high-tech manipulation. Sadly, humans, unlike me, are somewhat fragile, and along the route of production, Ray was ill. And so Ali stepped in. So, Ray will look somewhat different to how most of you will remember him. Before we get there though, and sticking with humans and how they operate, let's hear from Paul Nixon, our Head of Behavioral Finance, to unpack how the inner workings of the human brain can affect how your clients make their investment decisions and the impact this has.
Thank you, Nexi. Hello, everyone. Many of us have seen a version of the popular Anakin Skywalker and Padme memes. The same 4 panels where Padme plays the naive and clueless part interpreting Anakin's words, who we know becomes Darth Vader, in the most positive sense instead of their more sinister and true intentions. In a recent classic meme around Liberation Day, Anakin is replaced with President Donald Trump, who is looking at Padme and says, "I'm going to eliminate capital gains." Padme looks at him with a smile and says, "You mean capital gains tax, right?" President Trump says nothing and gives a steely stare back at Padme. Padme's smile and expression turns unsure. She comes to a different realization. There's been plenty of speculation flying around on the Trump administration's plans. From one end, where President Trump and his advisors are said to be playing 4D chess, executing a master plan, to the other end where no one really knows what's going on, but the idea is just to create maximum chaos. I'll leave that speculation to political commentators and economists, but there can be no doubt of the effects on markets, investors, and advisors. I've mentioned this before, but it's worth mentioning again. People hate uncertainty and markets are made up of people. In fact, a recent experiment showed that people prefer 100% certainty of an unpleasant electric shock to a 50% probability alternative. We have a piece of our brain near the brainstem that is the core function of predicting what comes next. When we can't, we don't like it. So how has Liberation Day and the associated raft of unpredictable tariffs played out on investors' portfolios? Well, I think you can guess, or I wouldn't be standing here giving this presentation, but let's take a closer look at the effects. The downgrading of US debt has perhaps cemented the unsustainability of US borrowing. Bond yields have also reflected the uncertainty around US policy. But ultimately, today's presentation is more about the advisor and investors' reactions to this uncertainty. To do this behavioral analysis, we take a normal sci-fi report year ending September 2024 and compare it to the more recent period of February 2025 to May 2025. A quick reminder that the latest sci-fi report is also available in the download section and also contains more detailed information on a lot of the analysis I'm presenting today. Lastly, when we refer to the Liberation Day period versus Liberation Day month, they refer to the extended period of February to May versus the month of April specifically, where reciprocal tariffs were announced. The reason we do this is that some analysis requires looking at trend changes, like the machine learning archetypes we analyze, while some requires us to look at a specific time or a specific event. For example, in the center of your screens, you'll see how much the US VIX or volatility index spiked during the Liberation Day tariff announcements in April specifically. This was the biggest spike since the COVID pandemic. Volatility usually causes behavioral changes. I'll remind you of these different periods though as we go along. The two blue bubbles on your screens represent the size of the average investment switch in the flexible investment option or FIO on the left and the retirement income option or RIO on the right. The average switch in FIOs for the latest or last sci-fi report, which was September 2023 to September 2024, was just over 150,000 Rand. Over the Liberation Day month, however, this increased by 30% to over 190,000 Rand. We can also see an even bigger increase in RIOs on the right. The average switch in RIOs for the last sci-fi report was just over 134,000 Rand. Over the Liberation Day month, however, this increases by 70% to just under 225,000 Rand. Next, we look at risk behavior. It is also useful to gauge whether investors or indeed their advisors are operating in a greed or fear mindset. To attempt this at a platform level, we use a method that assigns each fund on the Momentum Wealth platform to a category from 1 to 6. A category of 1 represents funds that are close to the cash and cash plus side of the risk spectrum. Category 2 assigns funds that have the most similar asset allocation to our CPI plus 2% outcomes-based funds. Category 3 assigns funds a rating of 3 where the asset allocation is similar to our CPI plus 3 outcomes-based funds, and so on and so on. Category 6 is reserved for the pure equity and property funds. If we take the category of the fund the investor is moving to and we subtract the category of the fund they're moving from, a positive number indicates up-risking while a negative number would indicate de-risking. For example, let's say an investor is moving to the Momentum Money Market Fund that has a rating of 1 and the switch is being made from the Momentum Equity Fund that has a rating of 6. The net move is negative. 1 minus 6 equals minus 5. And so this negative net move indicates de-risking. The reverse would indicate up-risking. So greed comes through when we have a larger net positive, and fear comes through when we have larger net negatives. This is certainly not intended to be a precise instrument, but it gives a decent indication of overall sentiment. It also tracks quite well with the Liberation Day event, and we can clearly see that the net negative movement in switching indicates a movement towards the cash or the fear side of the risk spectrum. This was the case in both FIOs and RIOs. Next, we dig into the actual funds that investors move to and from, which also confirms this sentiment. In respect to the top Liberation Day fund inflows, we can see the Momentum Money Market Fund dominating with well over R1 billion in inflows in both FIOs and RIOs. In respect of outflows, they're more spread out amongst funds, which is also to be expected, but we would see two of the larger outflow funds containing far more risky assets. For FIOs and RIOs, these are the Allan Gray Balanced Fund and Coronation Balanced Plus funds, respectively. In a nutshell, therefore, we have confluence or more signals that our read on the overall sentiment is in fact correct. Next, we answer the question of whether this activity adds or detracts from value. The pinkish bubbles on your screens show the annualized behavior tax for the 2024 sci-fi reports period. For For FIOs on the left, we saw an annualized value of just over 3.5%, while for RIOs, we saw a behavior tax of nearly 4.3% for this same 2024 period. For the Liberation Day month, however, we see that both these behavior tax values climb sharply. In FIOs by 80% to just over 6.3%, and in RIOs by 138% to just over 10%. I can tell you this would look much worse if we took the current Aussie performance numbers. At about 94,000 points, for example, the future performance of those equity funds that were left would have improved a lot, leaving many investors stuck in these less risky funds they moved into. This is how the behavior tax really accelerates, when risky assets start performing just after high volatility has shifted sentiments to fear. We saw much the same happening after the COVID period. Just 3 years after the subsiding of the global pandemic and investors finding themselves stuck in the same market turbulence trap. In a large study performed by Momentum Corporate using the Momentum Investments Money Fingerprint with just over 5,500 responses, it was found that certain money attitudes and personality traits are predictive of two-part withdrawals. So there are most definitely certain client factory settings that predispose these clients to certain behaviors. But there can be little doubt that the advisor is also involved here, each with their own attitudes and predispositions. The fact that we start to collect these factory settings opens up the world of opportunities in training artificial intelligence to provide nudges that are more appropriate to the client and the advisor context, and this is the future of advice that becomes rather bright. It matters little if the client has a higher risk tolerance, but risk is simply going to overwhelm the client in certain market conditions. Here, for retired clients, for example, a gap or combination of living annuity and life annuity is far more appropriate and will likely give better outcomes. Next, we look at exactly how the behavior tax is distributed amongst the main client archetypes. I'm picking on the RIOs here simply because our predictive machine learning model clearly shows that retirement income option products are more susceptible to switching. Some of the biggest switch predictors are the size of the portfolio. Obviously, retired clients have accumulated more assets. Age, retired clients are obviously older, and number of funds in the portfolio. This remains rather puzzling as the aggregate high number of different funds in a RIO client's portfolio is evident. Older people have more money but less time to recover, and so the damage done here is often difficult, if not impossible, to reverse. For this reason, we'll focus on the archetypes as they apply to RIOs. Unsupervised machine learning or clustering helps us to understand the structure of behavior patterns over time, and indeed if these are changing or not changing. While everyone tends to have stable attitudes towards risk over the long term, we like it or we don't like it, the reality is that how risk feels to each of us is likely to be far more volatile. This has been shown to be the case in a number of experiments where investors who experience consistent negative outcomes tend to feel heightened levels of risk, and those that experience rather consistent positive outcomes tend to feel reduced levels of risk. Both groups adjust their investment behavior accordingly. We can clearly see on the slide that the distribution of behavior tax over the February to May period changed from the 2024 SciFi report period, likely because of the Liberation Day event and the associated volatility. Two of the archetypes clearly stand out. The first is that of the anxious investor. The anxious investor is characterized by moving to funds with historically lower past performance and de-risking their portfolios. If you look at cash funds, for example, historically they underperform equities in normal market conditions, and so it looks like the investor is moving to worst past performing funds when in fact the primary objective is moving to safety and giving up the potential upside. Anxious investor behavior tax in RIOs increased by over 130% to just over 8.3%. Secondly, the market timer archetype is usually at the top of the pile when it comes to behavior tax. It experiences more than a 20% increase in behavior tax as well. Sometimes these investors are more responsive to upside and manage to get back into the risky assets a little faster. In all instances, however, investors are the ones losing. On your screens are two charts for market returns in the US, the S&P 500 on the left and the JSE All-Share Index on the right. Large crises are represented by large red areas and small ones by small red areas. The charts in essence give all possible monthly buy dates on the diagonal line and sell dates on the horizontal line from the end of 1996 to the end of March 2025. These charts are available in the download section. To use them, simply pick a buy date on the diagonal line and then move across to a time you'd like to see the return for on the horizontal line. Areas of light and deep red indicate drawdowns, and areas of light and deep green indicate good returns. White areas represent returns of between 0% and 5%. For the S&P, it should be remembered, though, that a return of between 0% and 5% could actually be an inflation-adjusted or inflation-beating return for the investor. Zooming out provides some good perspective, and the top 3 takeaways from these charts for you are as follows. Firstly, proportionately there is far more green than red. In fact, US markets over the past 100 years, bull markets have yielded an average cumulative return of nearly 150%, while bear markets have yielded only a 31% loss on average. So the financial physics of being rewarded for taking risk generally holds. But taking more risk does not equal more return. Taking more risk provides only the opportunity for such reward. There's no opportunity without risk. Volatility is a feature of risky assets, not a bug, simply because it works in both directions. In the download section, you can get high-resolution images of these charts. Do yourselves a favor and zoom in to see the smaller and larger red zones. Usually these occur with shorter-term time horizons. Holding for longer periods often eliminates the red areas completely. Secondly, it's critical to remember that red zones are not realized losses. They're paper losses represented by the fall in index value. A real loss or behavior tax is generated by selling existing holdings, usually bought in a green zone, at a time when the portfolio is in a paper loss, and switching out or selling them in a red zone. You only ever realize profits and losses by hitting the sell button. Thirdly, investing in the market or having a diversified portfolio gives the investor the upper hand in a transitory shift. Simply put, with a diversified portfolio, your client is always winning at something. Investing can be simple if we follow 3 simple rules. Firstly, it's important to get the money to work. The avoider archetype shows a grouping of people, for example, who get stuck in conservative assets. This generates a different behavior tax as inflation erodes capital. Secondly, don't put all your eggs in one basket. Diversify locally and globally using a DFM to give you the best possible mix of assets. Finally, and this is often the most important one, leave it alone. Turn behavior tax into behavioral alpha by keeping your clients invested and avoiding the behavior tax. Thank you.
Thank you, Paul. It's always fascinating to me to see how the chemicals, neurons, and electrical impulses can influence how humans do things. Now, let's dive into the meat of investing. And as I mentioned before, this is not some glitch in the matrix. This is not some high-tech shenanigans. This is indeed Ali, and not Ray, who will take us through Curate and the art of investing.
There is an intersection between art and science, a place where data and research come together with instinct and experience. This is where Curate lies, where the science of knowing what to do meets the art of making it all come together.
What is to curate? To curate is to be the custodian of very important assets. Now that works very well with what we do because we do 2 things and we do them very well. Firstly, we take care of things that are important to you. We take care of our clients' wealth. And secondly, we give you the comfort of knowing that we've done really hard work to find the best people to manage your money.
In a world that's noisy and uncertain, we focus on simplicity. We don't claim to predict what comes next. Markets shift, narratives change, and uncertainty is part of investing. That's why we look beyond the numbers to find great people who embrace this approach of simplicity. In a world full of options, we aim to simplify. Our fund range is focused and intentional, carefully selected to offer relevant funds, managed by people we handpicked to take care of your money.
Just like you've trusted us, we trust the investment managers that we've chosen to take care of your money.
It's about thoughtful selection, not broad assembly, giving you a clear and considerate place to start. This is Curate, the art of investing.
Good day, everyone, and thank you for spending your time with us today. We're fast approaching Curate's first birthday in August, and as we reflect on this first year, we are overwhelmed and incredibly grateful for the support and positive feedback we've received from the market. On behalf of the entire Curate Investments team, thank you for the trust you've placed in us. Today's session is a chance to go deeper into how our fund range came to be, and more importantly, how it connects to one of our core principles, relevance. One of Curate's guiding principles is that investment solutions must be built around clear client needs and objectives. We are very deliberate in building our fund range, starting with your clients in mind. Whether it's having money available for emergencies, saving for your children's education, or planning for retirement, we begin with what matters most. As financial advisors, your role is central. You identify the return profiles your clients need to meet their specific goals, and then help them to stay on track through life's many twists and turns. At Curate, we operate at the intersection of two worlds, science and art. We use the science to build an investment offering, but the art lies in choosing the right managers, applying judgment, and designing portfolios that make sense, not just on paper, but in your clients' lives. Our offering is built around three core client needs. Income for clients seeking low-risk cash plus returns, typically to preserve capital or draw a regular income. Capital growth for clients wanting to grow their wealth over the long term. And global diversification for clients seeking growth and currency diversification through offshore exposure. This is the Curate offering. Each of our 13 unit trust funds exists to meet a specific need within these three pillars, and we will unpack the design of each of these funds today. It's also very important to note that we didn't stop at these three pillars. We considered many more scenarios. Within each client need, there are subcategories. Within income, we distinguish between liquidity, or in other words, access to money quickly, as well as regular income needs. Within capital growth, we consider life stages, from wealth accumulation to wealth preservation. And global diversification, of course, addresses both opportunity and risk reduction. Let's explore these in more detail. Within the income pillar, we will work through how the Curate Momentum Enhanced Yield, Curate Momentum Flexible Income, and Curate Momentum Income Plus funds can be used. We start with our liquidity, or what we like to call now money. This chart shows the Curate Momentum Enhanced Yield Fund's monthly returns over the past 10 years. Most months, returns sit comfortably between 0.5% and 1%, highlighting the consistent liquid nature of this fund. Furthermore, withdrawals requested before 11 a.m. on Momentum Wealth are processed the same day, making this a true liquidity solution. Next is the Curate Momentum Income Plus Fund, also with a track record greater than 10 years. Most monthly returns fall between 0.5 and 1%, but more specifically, over the past 120 months, 118 months delivered positive returns, providing investors with a reliable stream of income. When compared to the ASISA multi-asset low equity sector, the Income Plus Fund shows greater stability compared to the broader range of returns displayed in the second chart. This shows that income funds are more predictable when clients' goals are to draw a steady income. But income is only useful if it is sustainable. The chart on the left assumes a steady income withdrawal rate of 5% per annum, adjusted for inflation each year. And the graph on the right shows that depending on which investment solution you choose, your starting capital after income payments may have a different trajectory. The table below shows the probability of sustaining adequate capital levels over a 10-year withdrawal period. With income funds, much like the Curate Momentum Flexible Income Fund, there's a 78% chance of preserving capital completely, and even in less favorable outcomes, 96% of capital is typically preserved. Now to capital growth and digging deeper into the use cases of the Curate Momentum Balanced, Curate Momentum Equity, and Curate Momentum Flexible Property Funds. This simple illustration shows 1 million Rand invested for 40 years in cash versus equity. It tells a familiar story. Growth assets are essential for long-term wealth creation. But what about meeting real return goals like inflation plus 5? These charts show that over 10 years, equity strategies are likely to achieve inflation plus 5 65% of the time. Moderate balance strategies, 67% of the time, and property strategies, 68% of the time. Whereas if we look at the strategies that worked really well for income needs, the likelihood of an income strategy achieving inflation plus 5% is about 18%, with the likelihood of a cash strategy achieving that target close to 1%. In short, allocation to growth assets like equity and property matter for capital accumulation. Moving on to wealth preservation, which is equally as important, especially near retirement. If a market shock occurs 35 years before retirement, an equity fund retains 88% of its value, and a moderate balance fund retains 94%. But 5 years before retirement, the equity fund might drop to 56% of its value, while the balance fund preserves 71%. In short, risk is not just about the return potential, but about when that risk happens. The Curate Momentum Balance Fund has a mandate that focuses particularly on capital preservation and limits downside risk in its approach. Now to global diversification. Let's unpack the advantages of using Curate's global equity funds. Adding global exposure across different geographies doesn't just expand opportunity, it lowers drawdowns, reduces volatility, and improves risk-adjusted returns. For example, a South African investor should consider diversifying into global assets to achieve broader geographical exposure and reduce country-specific risk. When investing into the JSE All Share Index, half of the revenue earned is from the African continent. By investing in the MSCI World Index, you add exposures to developed markets like the US and Europe. Complementing this with exposure to the MSCI Emerging Markets Index allows participation in the growth potential of rapidly developing countries such as India, Brazil, China, and other Asian countries. This geographic diversification helps balance risk and return by spreading investments across different regions, trends, and growing economies which are underrepresented locally. Furthermore, diversifying your portfolio outside of South Africa helps investors gain broader sector exposure and reduces concentration risk. The JSE All Share Index is heavily weighted towards sectors like resources, financials, and communication services. South Africa's overweight exposure to resources can lead to sector-specific volatility tied to global commodity prices and domestic economic conditions. In contrast, the MSCI World Index offers exposure to a more balanced mix of sectors, including technology, consumer defensive, and energy, which are underrepresented on the JSE. Meanwhile, the MSCI Emerging Markets Index also provides access to sectors and industries, like technology, that are driving growth in fast-developing economies. This diversification enables the investor to benefit from growth drivers across different industries worldwide, reducing reliance on South Africa's concentrated sector profile and enhancing the potential for more stable and diversified returns. The Curate Global Sustainable Equity Fund and the Curate Emerging Markets Equity Fund and their feeder fund versions are enhanced passive funds that provide clients with broad-based exposure to these companies represented within the MSCI World Index and the MSCI Emerging Markets Index, respectively. Our three actively managed style-specific global equity funds give investors exposure to value, growth, and quality styles within the global markets and are ideal for use within a diversified global portfolio. In summary, your client's money needs to solve for a wide range of goals. Now money, later money, and everything in between. That's why we were deliberate in the mandates we designed and in the people we chose to manage these funds. Curate offers a thoughtfully constructed range of funds designed to support clients across many different stages of their investment journeys. For liquidity needs and short-term goals, the Curate Momentum Enhanced Yield Fund provides a low volatility solution with daily access. Investors seeking a reliable income stream can consider the Curate Momentum Flexible Income and Income Plus funds, which are designed to deliver steady, inflation-aware returns. As clients approach retirement and capital preservation becomes a priority, the Curate Momentum Balance Fund offers a well-diversified, risk-managed approach. For those focused on long-term wealth accumulation, the Curate Momentum Equity and Flexible Property Funds provide growth potential through equity and real asset exposure. Global diversification is available through both our systematic range, such as the Curate Global Sustainable Equity and Global Emerging Markets Equity Funds, and our style-specific strategies, including the Curate Global Value, Global Growth, and Global Quality Equity Funds, are available, each offering a differentiated lens on global equity markets. Once again, thank you for your time, your partnership, and your belief in our approach. For more information about our funds and the investment managers behind them, please visit our website, curate.co.za.
Thank you, Ali. It seems to me that investing cannot operate without a uniquely human touch to steer the course and give consistent outcomes. So, next up, let's hear from Frobella Yates, the Managing Director of Equilibrium Investment Management, as she takes us through how they navigate the markets to help their clients reach their desired goals.
Thank you, Nexi. We know that equity markets are volatile, and we know that this is true of both local and offshore equities. There are many examples of volatility and market sell-offs over time, and this is true both in South Africa and abroad. But to illustrate the point, I'm going to use a few examples of sell-offs in the S&P 500 in the USA. The first is during the global financial crisis, where the market halved over a 12-month period. Then, in 2019, investors started to gain confidence in equities again and renewed buying happening throughout the year, only to have the market fall by 33% in a month. Volatility seems to be increasing and not decreasing, and can cause severe anxiety for investors. Markets fell 25% as a result of the Russian-Ukraine war. A more recent example was the 19% correction in a matter of days as a result of Trump's famous tariff announcements. But investors who stayed invested and focused on their longer-term outcomes were rewarded for doing so. As you can see, by using a longer-term lens, although these crises may have been painful at the time, staying invested may have seemed like the difficult decision. It was actually the right one. Investors who were able to ride the storm through the global financial crisis, through COVID, the Russian-Ukraine war, and even through Trump's tariffs, were very well compensated for doing so. The VIX index is used to measure volatility or market turbulence. And what this slide shows you is that turbulence is, in fact, normal. As we have seen, volatility is not new, but another thing that isn't new and won't be news to any of you is how high client sensitivity is to this volatility. Invariably, when markets are volatile but trending up, clients can stomach a certain amount of sensitivity. But when the volatility results in market drawdowns, then the risk tolerance seems to decrease. Looking at this slide, we can see how the VIX index spiked recently after Liberation Day. News of the tariffs and debate around the level of tariffs might have been the largest trigger in this example. But if you look back over the previous 15 to 20 years, there have been numerous examples of heightened volatility. Yes, there are periods where it's higher than others, but the key to success is to ignore this short-term noise and stay focused on your end goals. My parents always taught me not to make important decisions when I'm in an emotional state. This is true for so many decisions in life, and investment decisions are no different. I've seen how often the investors who panic every time there's a crisis or market sell-off or increased volatility are seldom rewarded with the ability to reach their long-term goals. As investment managers, we use our strategic anchors to remain grounded during volatility. Within our outcome-based investment philosophy, strategic asset allocation remains the cornerstone of the process, and we know that it is the primary driver of returns through the cycle. What this simply means is that you cannot achieve your outcomes or the benchmark unless you are in the correct asset classes. The strategic asset allocation process looks through cycles and ignores short-term noise, market mispricing, as well as short-term volatility. And it rather focuses on getting clients to their outcomes over the longer term. This encourages long-term thinking and keeps us aligned to our clients' goals over the relevant time horizon. As I mentioned before, drawdowns are often the trigger for clients to sell out of the market. So when we construct portfolios, we can not only focus on getting clients to the outcome, but we also need to focus on limiting the drawdowns, especially in the more conservative portfolios. We do this through the use of a robust and long-term strategic asset allocation process and diversification across and within strategies. This chart illustrates a fundamental principle in investing. Losses hurt more than gains help. For example, a 10% loss requires an 11% gain to break even, but a 30% loss, wow, that requires a 43% gain just to get you back to where you started. That's why one of the most powerful ways to grow wealth over time is to limit the downside and not just chase the upside. Our portfolios are designed with this in mind, to stay resilient during difficult periods so we can recover faster and more steadily when conditions improve. We do this through a combination of basing our portfolio construction around a robust and long-term strategic asset allocation and diversification across and within strategies. We saw the benefit of this through the period of volatility early in April. This slide shows how our different risk profiles behaved through the recent period of volatility. And what you'll see is that they didn't track the full extent of the market drawdown. That's intentional. Through diversification, active oversight, and disciplined asset allocation, we've structured these portfolios to absorb shocks more effectively. This is the benefit of working with a discretionary manager. We focus not just on the long-term growth, but also on managing risk so that investors can stay on track even when the market gets uncomfortable. Staying invested pays off over time and time again. I'll use our Equilibrium standard portfolios to show you the effect of this over the last couple of months. Although the portfolios were down after the tariff announcements, they actually recovered all of their losses over a fairly short time. And in fact, within a little over 2 weeks, they were actually higher than prior to the correction. If you understand the power of compounding, you'll also know that the effect is compounded and more evident in the more aggressive portfolios. So how do we link all of this to advice? Advisors know their clients' needs best, and they are therefore best placed to understand how each client is likely to react in various situations. And our advisors tell us that one of the biggest reasons their clients sell out is because they can't stomach negative volatility or drawdowns. So when we construct our portfolios, we don't only focus on getting our clients to their outcomes, but we are also cognizant of the journey that we take to get them there. Every portfolio is designed to target a specific downside limit. We use a measure known as VAR, or value at risk, to ensure that when markets are down, the portfolios are designed not to be down more than the stated VAR target for that particular portfolio. This allows advisors to have an upfront conversation with their clients and explain how each portfolio is likely to behave through the cycle and during times of excessive volatility or market corrections. Clients understand this upfront and so are less likely to panic during these short-term periods. Not only do they sleep more easily, but this serves as a guide in determining a client's risk tolerance. By aligning performance to a risk profile, we are able to target long-term returns without losing sight of the associated risks that come with short-term volatility. We build robust portfolios that are designed to perform regardless of short-term market mispricing or heightened volatility. And we do this through diversification across asset classes, styles, and geographies. As mentioned earlier, we begin with strategic asset allocation, then decide on how to execute in each asset class, and lastly, select the most appropriate fund or manager to carry this out. In very efficient markets, we might choose to utilize more passive components, while we know that in certain asset classes and geographies, we are able to deliver more alpha through allocating to active managers. Regulation 28 has also opened up more levers for us. We are now able to invest more in uncorrelated markets around the world and even get access to asset classes and strategies that are not always readily available in the client's home market. Our hard currency global portfolios look quite different to our local solutions, in that there we can more easily access liquid, non-listed asset classes, as well as other alternatives. And even for the offshore portion of our local portfolios, we look for different levers that allow for greater diversification. We've been involved in managing hedge funds for clients, both locally and internationally, and I believe that this is an area that we are more likely to see growth in over the next few years. We've said a lot, but I guess ultimately the proof is in the pudding. Our models continue to deliver consistent returns and in most instances are first or second quartile performers, beating both their benchmarks and the peers. Thank you for your time. Should you need more information, please reach out directly to us or to your investment consultant to see how we can help you grow clients' assets.
Thank you, Fluff. Now, let's shift gears and turn our attention to Janine van Heerden, the Head of Business Development at Momentum Securities. What food and investing have to do with each other is beyond my understanding. But in general, the human obsession with food is beyond my understanding. I'm sure she'll make it all clear. Welcome, Janine.
Thank you, Nexie. Good day, everyone. Today, I want to show you how to make trifle pudding. Trifle might not be everybody's favorite, but what I like about it is that you can really mix and match the ingredients to your liking. Before I get into it, I want to remind you of who we are, perhaps introduce ourselves to those who are not yet familiar with us. We are Momentum Group's stockbroker. We were established in 1938 and was bought over by Momentum and rebranded Momentum Securities in 2017. While the core of the business was traditionally centered around individual clients and direct relationships with our stockbrokers, the transition to Momentum has created new opportunities for growth through close collaboration with financial advisors. This is an exciting time for us as we continue to refine and expand our offering, guided directly by the insights and the needs of financial advisors like you. We are not content with being seen as merely a stockbroker. Our goal is to be your strategic partner, a partner who enables bespoke solutions tailored to your clients' unique needs with innovation limited only by legal boundaries. But let's make some pudding. So why trifle? Because it's a simple recipe with a layered structure where each component serves a purpose. There are a couple of tricks that you need to know to make sure that the flavors balance each other out and won't clash. And that's what I wanted to share with you today. You don't want to be in the position that Rachel Green was during a Friends episode when she decided to make trifle. The pages of the cookbook were stuck together, which made her make half a shepherd's pie and half a trifle. The only person that enjoyed the pudding was Joey. So not every client has the same taste or preferences and will need your guidance. And not every cook will have the common sense to know that there's no place for shepherd's pie in a trifle. It's essential to understand each component and how to combine them effectively, ensuring they complement one another and achieve the ultimate goal without it tasting like feet. Let's get started on our layers. Before you can even think about the ingredients, you need to have a beautiful bowl. Just like a good investment, it would be preferable to have a completely transparent bowl that will display the ingredients and the layers and show you exactly what you're getting. No guessing, no surprises. There are a couple of bowls that you can choose from in the market, and some can really only handle an apple pie. Still a tasty pudding, but limited. Momentum Wealth provides you with the perfect bowl that is not only transparent, but is big enough to handle multiple layers at once. It holds the investment together beautifully in one place. The assets in this layer forms the foundation of your trifle. This is where you will place your long-term assets that can be left alone for a while. You have to go through all the other layers before you can get here. This layer is made out of equity portfolios, hedge funds, and structured notes, and the purpose is long-term growth. At Momentum Securities, we can build a portfolio that even includes protection, providing you some certainty for the future. Our structured product offering can be custom built per client or group of clients and can provide capital protection, enhanced growth, or fixed coupons. As an example, our Digital Plus note provides clients with exposure to a basket of the top 50 shares selected from the MSCI World Universe and screens for companies with the highest percentage of domestic economic exposure, which are less reliant on overseas suppliers to high-risk countries and therefore not directly affected by the current tariff wars. The client has full capital protection and can receive either an 80% return coupon on any positive growth or the full market return if the growth of the basket was above the 80% over 5 years. This is a great way to give the client equity exposure without increasing their risk level. An ingredient that I prefer in my trifle is Swiss roll instead of the normal sponge cake. This gives a bit of sweetness and adds to the visual display of the pudding. From a Momentum Securities perspective, this would represent our partnership with Swissquote for offshore diversification. This partnership allows us to access over 60 different stock exchanges outside of Africa and more than 30,000 unit trust funds. Definitely a good place to build a diversified asset base. This level of our trifle allows the client to take on some more risk, as the assets can be left alone for longer. The other layers of our trifle will allow for this asset to keep up with inflation and time in the market to wait out any drastic market movements. Here, stock selection is active and intentional, and it can be adjusted as the market requires, with the client having view of the total portfolio and not just the top 10 holdings. Our offshore model fits perfectly in this layer, and it adds a beautiful touch of luxury and quality. I like to continue a pudding with a layer of jelly, especially different colours of jelly. This is the part of the pudding that adds flavour and colour, and it's a bit like income-generating assets, like dividend-paying stocks, or like unit trusts with moderate risk, like balance funds and ETFs. It's the portion of the portfolio that might shake a little bit during market volatility, but it won't lose its form. The purpose of this portion is to add yield without high risk. It bridges the gap between safety and growth, and at the same time, it keeps the portfolio flexible. At Momentum Securities, we would typically use income-paying ETFs, corporate bonds, or invest into our dividend portfolio for clients. This pairs beautifully with balance funds, like the Curate Balance Fund, for instance. Next up is our custard layer. These are typically your growth investments and can include shares, ETFs, and unit trust funds that are fluid, and it fills the gap between the different ingredients. This layer perfectly blends and binds with the rest of the ingredients. From a Momentum Securities perspective, we can offer our model portfolios either locally or offshore, where the portfolios are fully visible to clients with the added benefit of control and direct contact with the portfolio manager. Clients are increasingly asking for specific flavors to be added or left out when they look at stock selection, based either on ESG principles or their own personal value system. Having a share portfolio allows the client that freedom of choice and control. The time has also long gone where having a share portfolio is reserved only for the high net worth individuals. As you can see, we can accommodate the smaller clients as well. The fruit is our diversification layer that spreads the risk across multiple of ingredients. Think in the lines of equilibrium that provide you with a balanced combination of fruit in one can, saving you the time and the effort to select individual fruits that might not complement each other as well. You can quickly select a fruit that can spoil the whole investment. Momentum Securities add to the diversification here by accessing alternative investments to keep things fresh, dynamic and interesting. This might even include a structured product like the single stock auto-callable note that provides protection and digital coupon linked to the performance of a single JSE listed stock. As an example, we recently priced the APSA share with a fixed coupon of 30.5% over 1 year, if that stock had any positive growth over that period. This includes a 70% protection barrier, meaning that clients will have 100% capital protection as long as the share didn't fall with more than 30% at the end of 12 months. This is a really interesting note to include as part of a model portfolio. It's like adding an extra can of single fruit or even fresh fruit on top of the variety that was supplied by the mixed can of fruit. The cream is my favorite part of the trifle. It represents the short-term assets that are low risk, easy to get to, and it shouldn't be left there too long. Although all of the previous layers can be repeated in a trifle, this layer is normally one single layer right at the top, and it tends to spoil quickly. What I mean with that is that this portion is usually allocated to money market or income funds for the purpose of having emergency access or for income provision. If left too long, then the value won't keep up with inflation, and nobody wants sour cream. But it forms an important part of the whole portfolio, and it allows all the other ingredients to do their job. This layer can almost be seen as a type of protection layer that a client has to go through before accessing the rest of the assets. You want the cream to be light and fluffy and not runny that just leaks into the rest of the dessert. So it's not just about adding the cream. You have to make an intentional choice. Not all creams are created equal. When we construct a portfolio for a client that has an income need, we would typically consider income funds like Curate's Enhanced Yield or Income Plus funds or ETFs, as well as making use of government bonds to provide us with guaranteed coupons and maturity values. This gives great certainty, and the client knows that the coupon and the maturity amount remain unchanged, no matter what's happening in the world. It is a great asset to include for clients either building towards a retirement goal or already in retirement, and it needs some protection against depleting their assets due to the income requirement. The beauty is that this asset is also very liquid, and it can be adapted quickly if the need arises or when it's time to get out of bonds. On this slide, I'm showing you an example of the income yield received on the R2044 government bond. The maturity value and the annual coupon are guaranteed by the South African government and remains unchanged over the term of the bond. The income yield shown here is calculated based on the current bond price, and it doesn't even include the capital gain that this client will be receiving, meaning that the total return on this specific bond is above the 10% yield shown here. Definitely worth having a deeper look. The cherry on top is your client's goal with the investment. Whether this is to build an asset for retirement, a specific goal like purchasing a property, or to create financial independence, you and your client determine the end goal and the purpose. With Momentum Securities, you can either build your own individual pudding directly with us, or you can build a larger pudding that can be shared across generations by using the Momentum Wealth glass bowl to provide you with even more diversification of flavors, colors, ingredients, and multiple layers. The choice is yours. But know one thing, there is no limits to the combinations that are possible. When done correctly, each layer supports the other. A tasty pudding is much like a well-structured, intentional and evolving portfolio. Some might add a sprinkle of nuts on top. You might add a bit of frangelico liqueur to the Swiss roll base for additional flavor. That's what I like to do. The combination is up to you. With us, you will receive tailored advice, direct contact with a portfolio manager, complete control, and a personal approach with delicious results. Just like a good trifle, the best portfolios aren't rushed. They are carefully layered, tailored to taste, and built to be enjoyed over time. Get your personal custom-made recipe from one of our portfolio managers, and let's start building you a tasty trifle. Thank you very much for listening.
Thank you, Janine. As we prepare to wrap up the session, it always pays to go back, to summarize what's been covered, and to make sure that the short-term memory becomes fixed in the long-term synapses, and that the RAM becomes RUM. Let's hand the floor over to Momentum Investments CEO, Fadi van Heerden, to summarize the session and wrap it all up for me.
Thank you, Nexie. Good day, everyone. I trust that you have thoroughly enjoyed today's session with us. As we bring this incredible webinar to an end, I'm reminded of the African proverb that says, if you want to go fast, go alone. If you want to go far, go together. Looking at the caliber of our speakers today, it is clear to me that the collective power of our knowledge and experience is what will continue to drive this business far into the future together with you. I'm really grateful to have this team with me on this journey to deliver on our purpose for our clients. So let's take a quick moment to reflect on the key messages each of our speakers shared with us today. Firstly, Paul highlighted some of the observed behavioral trends in the face of the current tariff-driven volatility or any such market upheaval, with the uncertainty leading to portfolio switching, shifting to so-called safer funds, etc. We all know too well that market volatility will always remain a factor to contend with in some shape or form. A proven investment formula over the decades remains: start early, get solid advice, have a diversified portfolio, and to stay invested. Ray secondly then took us through the journey behind the creation of the Curate fund range and business, encapsulated in the phrase, as he says, science builds it, art shapes it. He explained that the offering was designed by first understanding what the client's core objectives are, be it capital preservation, income generation, wealth accumulation, or global diversification for that matter, and then formulating specific investment strategies to meet those needs. This is what I value about the Curate fund range. It is carefully constructed and thoughtfully shaped to meet client needs. Robert then echoed the impact of market volatility too, and spoke about its impact on client sensitivity. And she stressed the importance of staying invested to avoid locking in losses. Her team, of course, focused on strategic asset allocation to achieve long-term investment goals despite short-term fluctuations. Additionally, they have integrated valued risk methodology into their portfolio design, providing clients and advisors with a clear understanding of how portfolios are likely to perform across market cycles. This intentional approach to managing uncertainty is fundamental to equilibrium and should offer peace of mind over the long term for investors. And Janine then wrapped things up fittingly with dessert, trifle. Definitely one of my favorite puddings, I have to confess. Anyway, what a perfect metaphor to illustrate the delicate balance of portfolio construction. She emphasized the importance of understanding each investment component, from long and short-term assets, income-generating assets, to growth assets, and demonstrated how they interact in order to produce the optimum desired financial outcomes for clients. The perfect trifle, I should say. So I trust that you found the content today insightful and meaningful to your business and for your clients. Finally, thank you for choosing to spend this time today with us. We know your time is scarce and we really value the time that you gave us. So let's continue to go far together and build and protect our clients' financial dreams together. Have a great day ahead. Thank you very much and goodbye.
Thank you so much, Fadi. Oh, the Ray Alley paradox keeps coming back to haunt us like some ghost in the machine. For all of you out there, we know your time is valuable, and that's the one thing you can never get back. And so we appreciate your time and your attendance. For me, I will now probably be retired to a pile of pixels, and my time is over. So let me leave you with one parting thought. While machines are getting smarter and more capable by the minute, they will never be a replacement for the human touch. So thank you for being here. Stay the course and stay invested.